The SBA 7A loan is one of the most misunderstood financing products out there, but here's what you need to know. You can have up to $5 million of SBA debt tied to your name, and that can be spread across multiple SBA loans. And by the way, the vast majority of privately owned businesses are eligible for this program. It's not just for tiny businesses. I've personally financed businesses with $100 million of revenue using an SBA loan. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to reveal the inner workings of the SBA 7A loan program so you can use it to grow your small business empire. The SBA 7A loan program is a federal program by which the government partners with banks and 14 non-bank lenders to provide capital to small businesses. It's a job creation program, and it was created to ensure that small business owners had access to capital that was on reasonable terms. The way it works is that a lender is going to make a loan using their own capital, and behind that loan is a guarantee from the government that in the case of a default, they're going to cover 75% of the loss to that lender. So this allows the lender to take on more risk and provide better terms to the small business borrower. Now, some of the reasons a bank would not approve a loan to a small business owner under conventional financing terms might be a lack of collateral, time in business, or maybe if the business was in a higher risk industry. The SBA 7A program also allows lenders to provide terms that are more affordable to the small business. These advantages include longer repayment schedules, which lower the monthly payment, lower equity requirements, which help the small business owner preserve capital, and there aren't any loan covenants like there are with conventional, which offers more certainty to the small business borrower. The SBA lender can approve a 7A loan one of two ways, either in-house with their delegated authority, which is referred to as the preferred lender program, or by sending the loan package to the SBA for second approval after the lender has already approved the loan internally. Side note, I always recommend working with a preferred lender that can underwrite and approve your loan in-house so that you don't find yourself sitting around waiting for the government to approve your loan. The 7A is the SBA's largest lending program by far and garners bipartisan support on Capitol Hill. It's one of the few government programs that actually works. In fact, most years, taxpayer dollars are not even needed to subsidize the program. The government charges fees to the borrower and the lender, which in recent years has more than covered the cost of the program. The SBA has become more and more popular in recent years. The SBA administrator was elevated to a cabinet member in 2012, and in 2020, the SBA was responsible for propping up the Paycheck Protection Program in a matter of weeks, which ended up funding hundreds of billions of dollars to small businesses, again, with the help of the private sector, quite literally saving the economy in the midst of a worldwide pandemic. SBA loans are now known far and wide, but small business owners need to understand that the 7A program is much different than the PPP program. The SBA gives the lender a lot of control over what they'll approve, how they'll structure the loan, and the process can vary tremendously from lender to lender. So keep that in mind if you ever decide to tap into this program to start, grow, or acquire a small business of your own.
So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.